Here's a quick daily brief, August 14, 2013. It's Wednesday. Just a quick kind of a fundamental note. I talked a little bit about the Hindenburg omen, which is a technical kind of thing for the markets, a technical indicator of a possible crash coming in the market. Talked a little bit about that yesterday. And there's a fundamental study that Dan Seaver does, who's a faculty member at Cal Poly State University. And basically what he does is take a value line, which is a kind of a fundamental research department or company. They follow about 1,700 stocks. And he comes up with a single number calculation based on what the analysts who follow those stocks, what their outlook looks like for the companies for the next 3 to 5 year period. And based on the collective outlook for the 1,700 stocks, he comes up with a single number. Now, if that number is above 100, that means that the risk-reward relationship, in other words, the upside potential for the stocks is strong enough to warrant taking the risk to buy them. If it's below 55, then you should be a seller because the risk-reward relationship doesn't look good. Now, just for comparison's sake, back at the peak of the market in 2007, this index hit a 40. So it was definitely below the 55, meaning that you should sell. And over the 30 years he's been doing this, it's been very accurate. Right now it's at a 35, so it's actually 5 percentage points or 5 points below the 40 that it was at the peak of the market in 2007. It's not a short-term timing deal because we're looking at a 3 to 5 year outlook for the fundamental side of things for analyst expectations, but it's been very historically accurate over time. So what it's basically indicating is that it doesn't make sense to put new money in the market and investors should be raising cash. Now, that doesn't mean the stock market's going to crash tomorrow, but if you overlay all these different fundamental things like this index and you look at the technical side of things like these Hindenburg omens that we talked about, things are starting to sort of all line up on the same side of the page, and they're all indicating that the market is due for a correction. When that happens, we don't know. Markets can go up for months, even years, even when they get overvalued, overbought, too expensive. We've seen these things happen before based on a variety of different factors. But if you throw in rising interest rates, Fed tapering, slow economic growth, high unemployment, and all these market indicators that we're seeing both on the fundamental and technical side, it does tend to make you think that we're going to see a correction sooner rather than later. I know I've been calling for one for quite a few months now. Granted, I'm not a market timer. I just see risk and reward in the market. I think stocks are really expensive here. I would love to see a correction. In the longer term, I like stocks in comparison to real estate and commodities and bonds, of course, with a rising interest rate environment. So I like stocks. I just think they're too expensive, and I want to see the market come down to make it more attractive to buy. Rest assured, I will be a buyer once the market comes back down.